Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Here again to give you my professional and honest opinion regarding the 2022 Canadian housing market. This week I had some places left out of the statistics for price points and whatnot, so I'm going to go over those briefly. Talk about when you should enter the market or when you should buy. I figured out kind of like a recipe for entering the market, and just some general thoughts after that. So this is going to be a good one if you're looking to buy, and I get asked that question all the time, when should I buy? So it's hard for me to say that, but I do have some really good information in this video about it. All right, so with the statistics, let's start from the east. You usually start from the west, but I didn't have all the data last week, so we're going to start from the east. I got 3 places: Halifax, Montreal, and Treb, or Greater Toronto area. So we'll start with Halifax. So these stats are brought to you from the Andrew Perkins from Keller Williams out there. He seems to have a good monthly blog, so I grabbed the statistics from him. And you can see single family has remained fairly flat. Andrew, or his blog, has more on that, which I'm going to read shortly. And the condos have declined significantly. It looks like they're down $100,000 for the average condo price in Halifax right now. So Halifax is starting to see price declines. Again, not so much in the single family, but the sales have decreased. So this is what Andrew's blog has to say about that. This summer, we have noticed significant shifts in the Halifax real estate market. Houses and condos are not receiving extreme bidding wars like they were in the beginning of the year. Buyers are concerned about rising interest rates, inflation, and are scared off by how intense the market has been for the past 2 years. More and more sellers are catching word of how much the market has been in their favor, and with the warmer weather are ready to list. This has caused an increase in inventory, lessening the competition for buyers. We're in a better market now for buyers than we have been since the pandemic began. And some significant numbers to note. The average condo price in comparison to this time last year has only increased by 2%. This is significantly lower than the trend we have seen over the past 2 years, typically 20 to 30%. This is evidence the market is slowing. Average days on market, both in single-family homes and condos, are still selling on average in under 2 weeks. This is especially true for properties close to amenities, within the $300,000 to $500,000 mark. The market is slowing. We are still in a seller's market. We enter a buyer's market when we have over 6 months inventory. We are currently at just over 1 month of inventory. So interesting there from Halifax. Obviously, they're lagging behind the rest of the country in what's happening in their markets, but they're starting to see it now. And we'll keep following them, obviously. And now for Quebec and Montreal. I got a lot of requests for actually Montreal, so I have both the province of Quebec and Montreal here, brought to us from the Quebec Professional Association of Real Estate Brokers. And in their press release for the July numbers, it was released August 4th, the real estate market slowdown intensifies in July. Prices confirm their decline. Following on from what was recorded in June, the shift in the market dynamics is clearly confirmed. The magnitude of the interest rate hike in just 4 months has accelerated the market slowdown, albeit much more gradually than in other major Canadian cities. While it is true that the summer season is usually quieter, we are seeing a marked deceleration of July's sales pace, while simultaneously active listings continue to reflect a decidedly upward trend, especially in the area surrounding the island of Montreal and Laval. So single family here for the province of Quebec, you can see the peak was in April, 450,000, and it's down to 416. So you have about a 7 to 8% decline in the average single family house price in Quebec right now. And the condos are following a similar trend, a little bit less, but it's not far off. High was in April at 384, now we're at 365. And as for Montreal again saw their peak in April at 580, and we're down to 550. So again, 6-7% decline in the average single family. And in the condo market, it's remained fairly consistent since April, but we did see the first decline now in July, approximately 20,000 or 5%. So obviously, clearly, prices have reversed in Montreal, lagging behind Ontario and BC, but they are following the downward trend like the rest of the country now. And lastly, Treb, or Greater Toronto Area, the Toronto Real Estate Board, total transactions are down 47.4% over last year in July. So it's almost a 50% decline in transactions. It's pretty huge. And month over month this year, they declined another 7.3%. So again, that downward trend is still happening. And let's move on to selling price. So year over year, they're still up 1.2%, but from the peak in February, they're down 19.5%, or approximately $260,000. The average house price, residential price, has dropped, which it's pretty significant. It's more than Ontario as a whole. It was around 200,000. This is obviously significantly higher, 25-30% higher. And of course, they do a seasonal adjustment. They're actually down 2.6% from the previous month. Year over year, 4% less listings. It hasn't really changed from last year. And the sales to new listing ratio has dropped significantly. So clearly it's more of a buyer's market there than it was last year. And of course, you'd expect days on market to go up, which it has. It takes longer now, 29 days as opposed to 21 days last year. And month over month, it's even risen about 25% extra time to sell your house, or 4 days. Okay, so now we're done with those stats. This is, again, probably the number one question I get. Actually, I get calls on this one too. When do you enter or re-enter the market? If you're buying, it's hard to say when should you buy, because you could be buying because you just sold your house and you're moving to a bigger or smaller one, right? That's fine. Buy, sell, do what you have to do. This applies to people that are entering, so it could be first-time buyers or immigrants or whatever the case may be, or people that re-entered. A lot of people did sell. They got stuck in the bidding wars in February and they ended up not buying. So they've been sitting on the sidelines. When do they buy? And it's hard for me to say. People say, do you think we should wait until 2023? Should we sell at the end of this year? Well, that's hard to say, because I don't know a timeline with a date, but I do know what to look for, because I just did my research and it's pretty interesting. So let me know what you guys think in the comments, if I'm onto something with this or not, but let's go through it. I'm going to try to make it as easy as possible. And there is 4 things. I call it a recipe, because you need to include all these things to be sure and safe that you're buying at the right time. You can't just use one of them, so don't just look for one of these indicators and buy. You need all 4 to have the highest confidence level if you are buying. And we're going to use it based on historical data and trends, right? So first of all, I would say number 1, you need a declining price point, right? When prices are dropping and you've just gone through a big decline, or maybe it's a small decline depending on the market situation, that is one of the things, one of the first things you should look for. Canadian data and home sale prices, or average Canadian prices, the data is limited past 2005, so I'm going to use a couple of different ones from a couple of different areas. This is Canadian. I'm going to use Ontario next, but again, I'm using these different ones because the data is inconclusive. Before 2005, there wasn't a lot of tracking of price points or Canadian MLS data, so this is why it's limited. So, but anyway, we know historically when prices did drop and when recessions were and whatnot. So let's check this out. So 2009, obviously after the 2007-2008 financial crisis, prices did drop. Great time to buy based on average prices, right? The end of 2017 was a good time to buy. Interest rates started to rise and the market started to slow. Obviously, you can see the Canadian average price point dropped. And we're looking at the red line, not the blue line. That's obviously the MLS HPI, or home price index, which I don't like. I like the average a lot more. So that was a good time to buy, obviously, looking backwards, right? In Ontario, those times line up the same. It was 2017. You can see now Ontario didn't dip in 2017. I think it was BC had the bigger losses. But anyway, it was the time to buy. After here shows 2008. Again, different markets are different times, but again, it's a very similar time scale. And you can see those other 2 arrows. There is actually, the data is so small compared to nowadays that you can't actually see the dips, but there are declines in those areas. So again, that was 2003 and in the mid 90s. In the 90s, you could have bought any time actually, because there was really very little price growth in the 90s. Number 2 thing to look out for, or indicator, or part of the recipe, is interest rates. I've said this before, and of course, interest rates go up, prices come down. Interest rates come down, prices go up. These things you'll see, they're going to line up. It's very consistent. So you see the interest rates, they went from a high to a low back in near 1995 there. It was about 1997. They went from just over 8% down to 3. And this is the Bank of Canada interest rates. Great time to buy. And then next one was 2002 approximately. Interest rates came down. They went from a high to a low. Of course, good time to buy. We all know in the 2000s, up to 2007, 2008, there was nice price increases. So it would have been a great time to buy. And here it shows 2009 and 2010. After 2008, again, interest rates went from a high to a low. Great time to jump into the market. And the next one would have been 2016 on this graph, but it doesn't go that far. Again, partial data from where I'm getting the stats, but you know yourself, interest rates declined in 2016. It was a good time to buy, or 2017. So of course, interest rates, you got to watch those. They got to go from a high period like we're in now. When they drop back down, keep an eye out for the rest of the indicators. Number 3, the unemployment rate. You got to watch the unemployment rate, and that has to go high. We want that to go high, from a low to a high. Right now we're at historic lows, but looking at this chart here, or this graph, you'll see, let's go back to the 1981, 1982 recession. Unemployment peaked. I don't know if that was a good time to buy housing. Probably was, but I don't have my data back this far. 1990 to 1991, or 1990 to 1992 recession. You can see unemployment peaked after that. You could have bought at that peak or just after. That was probably 1992, probably 93, that peak. But unemployment did a little peak again in 1996, 97. Great time to buy. Unemployment peaked again, went from a low to a high in the early 2000s, 2002, 2003. That was a great time to buy. And of course, after the 2008 recession, unemployment went from a low to a high in 2010 approximately. Good time to buy. And here you have the last one. Unemployment peaked a little bit in 2017. Good time to buy. And here's just another graph with the unemployment rate bringing us further towards 2020 or 2022 right now. Of course, that big spike on the right is the 2020 pandemic, April. But let's look back again, seeing it on a different graph. That would have been the mid-90s there, the first one on the left. The second one was 2002. Third one was 2010. The next one, 2017. And of course, when's the next one going to be? 2025, I predict, maybe 2024. And number 4, the fourth thing to look out for in our buying recipe is the mortgage arrears, the spike in mortgage arrears. It's kind of like, probably follows unemployment, right? You see, this is the mortgage arrears. It's from the Canadian Bankers Association. You can look it up, it's on their website. You'll see 1997 approximately, mortgage arrears started to spike. It was a good time, just like the rest of the indicators, to buy. And then anytime in the 90s, even 1999 was a good time to buy. And then again in 2002 approximately, it spiked. Good time to buy. 2010, the mortgage arrears spiked. It was a good time to buy. 2016, 2017, it trended up a bit, but looking back on history, it would have been a good time to buy. And we're not going to you could have bought in 2020, but it would have been a short-term buy. You would have made lots of money, but that was an anomaly, the pandemic, and who knows what could have happened. So it would have been a risky buy if you had bought back then. So again, 4 indicators. All of them, I believe, you need to have in place in order to safely buy at the most appropriate time in the real estate cycle. And I put it into a chart here just so we can quantify the years and let's see them all together. So the average price in Canada, again, it only went back to 2005, but it would have been 2009 and 2017, the best time to buy. Ontario, a little bit different, but 95, 2003, 2008, 2017. Based on interest rates, 97, 2002, 2010, 2016. Based on mortgage arrears, 97, 2002, 2010, 2017. And based on the unemployment rate, 96, 2003, 2010, 2017. And you can see here I put the years between cycles because there is a trend, right? Real estate works in trends and cycles. And some people, you say, well, it's like a 10-year trend. Well, it looks like it's been a 5 to 8 year trend. So we're not going to use the Ontario 9-year because it's a smaller sample size and it's just one province. But nationally, it's a 5 to 8 year trend. Let's look at the length of the fluctuation. So the average price in Canada, it took 1 to 2 years on average for those 2 cycles to go from the previous high to the low. Interest rates, it took 1.5 to 2 years on average for those 4 cycles, those 4 years I have, but it took 1.5 to 2 years from the previous high to the low for interest rates to move from that high to low. Mortgage arrears, it took 1.5 to 2.5 years from the previous low for the arrears to get to their high. And the unemployment rate, it took 1.5 to 2 years from the previous low to get to the high. With all that said, I said I'd try to keep it simple, so I'm going to summarize what I said now. So it's clear to me that there's things that line up, and these things line up. You can talk about stock markets and stuff, but stock markets, they may or may not be related to real estate and Bitcoin and all that stuff, but these things they're 100% related to the real estate market, to home ownership, and we can see cycles. So the cycles are 5 to 8 years. Our last cycle here was 2017, or buying opportunity. These are buying opportunities, right? So 2017 was the last buying opportunity. Before that, it was 2010 or 2009. 5 years is right now. It's obviously not the time to buy. Interest rates are not low. Mortgage arrears are really low, and the unemployment rate is really low. So nothing besides declining prices is in our favor. So prices are going to continue to decline, and there's nothing to say that they won't. All the other indicators say prices are going to continue to decline, and every professional will say that too. If they don't, they better check their numbers, because there's no way that real estate is not going to continue to decline with higher interest rates at this point. Given that it takes mortgage arrears 1.5 to 2.5 years to go through their cycle. We're at a low, so it's just starting their cycle. They've started to level off. Considering that they might start to uptick now, you're looking at 1.5 to 2 years from now. The unemployment rate, all-time low. We need that to go to an all-time high. That's going to take, based on historical data, 1.5 to 2 years to do that. And the interest rates haven't reached their peak yet. We need them to go from their peak to a low point. Now that low point could be, the Bank of Canada rate could be 1.5%, 2%. Who knows? I don't know what their low point is. But again, we haven't even reached the high, and it's going to take 1.5 to 2 years to get back to that low. So maybe we'll reach the high in the fall or in September when the Bank of Canada does their next announcement, which they're probably going to hike it again, but we'll see. So given that, you're still at least 1.5 years away from a buying opportunity based on this data, which brings us into line to that 6 to 7 year time. My prediction based on this data is 1.5 years at minimum from now. Let's just call it 2 years. So 2024 will be the low point of prices, and it could be the end of 2023, it could be the beginning of 2025 or mid 2025, but just on average, let's call it 2024 for unemployment rate to be high, mortgage arrears to be high, interest rates to have dropped back down to a low level of some kind, and of course the prices to have reached their bottom. So yeah, let me know what you think. I thought this was pretty interesting data. That's the answer, and I know tons of people ask it, and I wanted to try to figure something out on it. So this isn't a recipe for disaster, by the way. That we've already had the recipe for disaster, low interest rates and all the rest of it. This is a recipe for success for when you should buy. Okay, now lastly, I just wanted to talk about and people ask for this too, what do I see going on in the market out there? And, besides the normal, like there's less buyers and there's less sales, like that's pretty much a given in all markets right now. Actually, it is a given in every market in Canada. Some things I've seen that, you may not hear about as a consumer, and one of them is I find hilarious. So I do a little dabbling outside of my Niagara market. I don't really do much, but even just talking with people. And there's this one listing I was involved with, and I didn't end up taking it on, but, and if you're watching the seller, I'm not obviously going to say your name, but I thought it was worth around 1.2. I'm not going to say the city. I'm not going to give you any details beside prices. And he said, look, we want to list it at 1.35. And I said, well, that's going to be more than I wanted to list that. Like, I think it's worth 1.2. It's this style of home with this many bedrooms, and there's been some other sales and the market's declining. Like, you can't list high. You have to list reasonable. So anyway, he wanted me to list it, and then at the last minute he changed his mind and said, oh, we got someone's going to list it for us for 1.35. And I said, no problem, good luck. I'm not going to take a listing on anyway that's overpriced. I think I did like tell him I would list it a little bit higher for a week or two, but it wasn't 1.35. So anyway, I see this listing come on the market, because I watch sometimes. I say, let's see what happened to that listing, because I want to see what happens. It's experience for me, right? I could be wrong. I'm not always right. Sometimes I'm wrong. It comes on at $998 or $999, and I'm like, okay, obviously they're gonna hold off on offers like they did back in February and January when the market was crazy. You'd list a place, you'd hold off on offers for 7 days, and you'd create bidding wars. So I'm thinking, okay, maybe they're going to try that. Like, put it very low, under $1 million, get bidding wars, and I don't know. I don't think they're going to get 1.3. I'm going to watch the listing, but I don't think they are. So of course, then I get another comment on one of my videos talking about one of the shows on TV with Al Sinclair. So I go and watch this. They talk about the market, and then they go through his 4 properties wherever he has listed, and like 2 or 3, I think it was 3 out of the 4, they're all waiting on offers until like the Tuesday and the Wednesday. So the agents, again, not in my area, but in GTA, they're going back to this bidding war style thing. And I don't know if they're doing it to get creative, because they know it's getting hard to sell homes. They're sitting, so let's put them low, create bidding wars. Now, we stopped doing that because it didn't work. So I'd really like to watch. And I just noticed this in the last week. So again, pretty interesting. Let me know if you've seen any of this, but trying to create bidding wars in a falling market would be very interesting, and I want to know how it works out. I will be watching the one listing I talked about, but again, pretty interesting dynamic. So the other thing that I see a lot of, looking at our daily new listings and hot sheet it's called, and we see all the new listings and all the price reductions. There's tons of price reductions. In the last week in my region, the Niagara region, we've seen just under 10% of the total listings get a price reduction. And that's just in 1 week. So within 1 week, just under 10% of all listings got their price reduced. So again, it's a falling market. Prices are dropping, so obviously price reductions are normal. But yeah, it was just interesting. Usually on the hot sheet, you'll see like a couple for every city. Now they're just like lined up, right? The general sentiment in the market is like there's no lack of urgencies with buyers. They're taking their time. They'll sell their house if they have a house to sell. They can try to sell that, try to buy, because they know you can't just go out and buy, because you still have to sell your house, and your house might take a while to sell. So yeah, there's the lack of urgency now, you see for sure. And a very interesting thing I saw when browsing listings for clients was building lots being sold and vacant land being sold by builders. So like builders, that's like their paychecks, right? But when you see builders selling off their lots, and these aren't small builders, some of them were the bigger builders, it was very interesting, because I haven't seen that in like years. So a sign of the times, builders are now starting to sell their building lots, and they probably foresee what's going to happen, right? They see, look, we're not going to make money on this. We can still sell this lot for X number of dollars, or try to. So yeah, so builders are dumping lots. And again, I wasn't even looking for them, and I saw 2 builders selling lots just in like 5 minutes of browsing listings. So pretty interesting dynamic that also. So yeah, hopefully you got some value from my home buying recipe today. One thing I forgot to add was, right now interest rates are high, so why would you buy now anyway? Like the prices, you're paying more or equal to what you would have been paying per month back in February when the prices were $200,000 higher. So yeah, it's not a good time to buy for 3 of those 4 indicators right now. The only thing that's happened is prices have dropped somewhat. So I know I wouldn't be buying or upgrading until those things all fall into line. Anyway, thanks again for watching, and until next week, I'll see you then.